Hello, my name is Sefian Chandra, from the accounting program, with student ID 24412035. I would like to explain what an account is, the types of accounts, how the normal balance position works for each account, and tips for writing or transferring transactions into the general journal. An account is a systematic representation of financial elements that records all transactions occurring within a business entity. Accounts serve as a tool to organize and classify financial information so that it can be easily analyzed and reported in financial statements. Each account has a clear structure, which typically consists of account name, a name that describes the type of transaction recorded, such as cash. Accounts receivable, or accounts payable. Account number. In an accounting system, accounts are often assigned a unique number for easy identification. For example, the cash account might be numbered 101. Balance. Each account has a balance that indicates the total value recorded. This balance can be either a debit balance or a credit balance, depending on the type of account and the transactions that occur. Types of accounts. There are 5 types of accounts. Asset accounts. Definition. Asset accounts include all wealth owned by the company that has economic value. Assets are divided into 2 categories, current assets and fixed assets. Current assets, assets expected to be converted or used within 1 year. Examples: cash, cash held by the company. Accounts receivable, money expected to be received from customers. Inventory, goods held for sale. Fixed assets, assets used in company operations with a lifespan of more than 1 year. Examples: land, land owned for company use. Buildings, the structure where the company operates. Equipment, machines and tools used in production. Normal balance, debit. This means that when assets increase, they are recorded as a debit, and when they decrease, they are recorded as a credit. Liability accounts. Definition. Liability accounts record all debts that the company must pay to third parties. Liabilities reflect creditors' claims against the company's assets. Short-term liabilities, liabilities that must be settled within 1 year. Examples: accounts payable, debt arising from the purchase of goods or services on credit. Tax payable, tax obligations that must be paid. Long-term liabilities, liabilities due more than 1 year later. Examples: bank loans, loans received from banks that must be repaid over time. Bonds, debt securities issued by the company to raise funds. Normal balance, credit. This means that when liabilities increase, they are recorded as a credit, and when they decrease, they are recorded as a debit. Equity accounts. Definition. Equity accounts record the owner's investment in the company and retained earnings. Equity reflects the owner's claim on the company's assets after liabilities are deducted. Pledging capital, the owner's initial investment in the company, whether in cash or assets. Retained earnings, profits not distributed as dividends but reinvested in the company for growth and expansion. Normal balance, credit. This means that when equity increases, it is recorded as a credit, and when it decreases, it is recorded as a debit. Revenue accounts. Definition. Revenue accounts record all income earned by the company from its operational activities. Revenue is a primary source of cash inflow and an indicator of the company's performance. Examples: sales revenue, income from selling goods to customers. Service revenue, income from services provided to clients. Other revenue, income from other sources not directly related to the main activities, such as interest received. Normal balance, credit. This means that when revenue increases, it is recorded as a credit, and when it decreases, it is recorded as a debit. Expense accounts. Definition. Expense accounts record all expenditures incurred by the company to conduct its operational activities. Expenses are the costs necessary to earn revenue. Examples: salary expense, expenditure for paying employee salaries and wages. Rent expense, expenditure for renting buildings or spaces. Utility expense, expenditures for electricity, water, and other services. Depreciation expense, allocation of costs for fixed assets over time. Normal balance, debit. This means that when expenses increase, they are recorded as a debit, and when they decrease, they are recorded as a credit. How to enter transactions into the General Journal. Entering transactions into the General Journal is an important step in accounting that allows a company to systematically record all financial transactions. Here are the steps to enter transactions into the General Journal. Identify the transaction, determine the transaction that occurred and its impact on the relevant accounts. For example, if the company sells goods for cash, it is necessary to record the cash receipt and the increase in revenue. Determine the affected accounts, identify which accounts will be debited and credited. Each transaction typically affects at least 2 accounts, double entry system. Example, a cash sale of goods will affect the cash, asset, account and the revenue, income, account. Determine the amount, specify the amount to be recorded for each affected account. Ensure that the total debit amount equals the total credit amount. Create the journal entry, write the journal entry in the General Journal using the appropriate format. The general format for a journal entry is as follows: transaction date, name of the account being debited, in a separate format debit amount, name of the account being credited, in a separate format credit amount, brief description of the transaction, optional but recommended. Example of a journal entry: suppose a company makes a cash sale of Rp1,000,000. Here's how to record it. Identify the transaction, cash sale of goods. Determine the accounts, account debited, cash, asset account credited, revenue, income. Determine the amount, cash, Rp1,000,000, debit revenue, Rp1,000,000. Credit tips for entering transactions into the General Journal. Ensure balance. Always ensure that the total debit amount equals the total credit amount to maintain accounting balance. Use clear descriptions. Provide a clear enough description of the transaction to facilitate understanding in the future. Order by date. Enter transactions into the journal based on their date for easier tracking. Double check. Always review the entries made to avoid errors.